Hey everyone, the title of this segment is Black Swans, Magic Unicorns, and Fantasyland. So I'm filming this on March 3rd, 2020. So of course the Black Swan is in reference to the unfolding coronavirus event, and the Magic Unicorn is in reference to a quote I gave at the beginning of 2020 as part of the market forecast. I was asked if I thought the Miami market would improve or stay the same, and I said that the Miami market is not a magic unicorn that will defy supply and demand fundamentals. And the Fantasyland, third little point here, is a fun topic that we'll get to in the end. So, Black Swan. Actually, before I delve into this, a little bit of a footnote. The Fed had an emergency 50 basis point reduction today. The 10-year hit went below 1% for the first time. I would just like to add that people think the Fed has this magic ability to use its ammunition, drive down rates, and somehow juice the markets. The market went up a little bit, and then it continued the decline from last week. And what I'll say is that the Fed coming in to cut rates is nothing, I think, nothing more than a catalyst for a crash in sentiment. It's acknowledgement. It's a pessimistic move. And the U.S. has never had negative interest rates, and that would be a real catalyst in a crash in sentiment. So anyways, back to the Black Swan. So what is a Black Swan event? The Black Swan event is defined as an event that sort of comes out of the ether. It's something completely unexpected. You can't account for it in your probabilistic models, your risk models, anything. It's something that by definition is unpredictable, and it's something that has a very large extreme effect on whatever it is affecting. So the term was popularized by Nassim Taleb, who wrote The Black Swan. He also wrote Anti-Fragile. I'm a big fan. He's a very active tweeter. I read his tweets sometimes for fun. And a little bit off topic, but about 2 years ago, he had a great tweet. He was visiting downtown Miami, and he wrote, "Downtown Miami, something so refreshing about a town so devoid of any pretense of intellectualism." And I thought it was such an on-the-money, funny quote about Miami. But anyways, that is a Black Swan. It is something totally unexpected that comes and has these huge effects. Now, another characteristic of such an event is that it can be used as a construct for narrative. Now, it is human nature to want to create a neat, clean story, a neat headline around an event. It is human nature to attach causality to whatever is the loudest nuisance in your face. Most people cannot abstract past that and remove themselves from the active sort of annoyances into the big picture, and that's where the magic is. It's in the big picture, but people usually can't do that. So they want to create a story, and Black Swan events often serve that purpose. They're often, they could be the camel that breaks the hair that breaks the camel's back, and it creates all these ripple through effects, and then the story post fact, it was all caused by the Black Swan, but in reality the setup was there. That was just the tipping point. And I believe that's what we're witnessing here with the coronavirus. It is the nature of humanity to have cycles. Cycles go all throughout the history of the world, the history of markets, and anyone who tells you that this time is different, I mean, that's like the cliche. I had a meeting about 2 weeks ago with this guy's economist from Yale or something, and he actually told me that we've evolved past cycles, he thought. And I looked at him and I said, wow, I think you might be the contrary indicator for the top. And he wasn't offended. He didn't even get what I meant. But no, we have not evolved past anything. The markets are, momentum and sentiment are real things, and markets, you could really think of them as the aggregate of human herding behavior. And in a time of uncertainty, fundamentals don't even matter. Momentum can go either any which way, and no one really knows why. Humans are not rational animals. Just because we have fancy cell phones doesn't mean that the human animal has evolved in 100 years past the human animal that caused World War I, for instance. And there are thousands of books written on that topic, and no one really knows why World War I happened. And we are still that same animal who did that. So wanting to say that we've evolved past human nature isn't really a good reason to not look at what's obviously in front of your face. So what are the big macro, there were many big macro trends that were in, sort of precarious extremes before the coronavirus. So when I look at the market, the Miami, residential market, which I make reports available on, is a very simple market to look at. You want to try to find anomalies. You want to find where things are at extremes, because markets seldom stay at extremes. It's like a pressure buildup, and then it has to go the other way. And And so the broader market before Corona had all sorts of extremes. We have $14 trillion in institutional debt yielding negative. The ECB benchmark was negative since 2014. Record long bull market run in U.S. equities. All sorts of things. And so when I said that about the Miami market not being a managed unicorn, it can't get better, it's because the conditions here are so fundamentally bad, and it's within the context of this broader market that also had all these weak points that just needed that external trigger. And in fact, I wrote that in my supply and demand report. I said the Miami market is very vulnerable to an external trigger event because it's so precarious where it was. One macro market chart that I will look at before I go into the Miami market is this one here. So this charts household wealth as a percentage of DPI, and the red is the Fed funds rate. So this is a crude drawing, but the shape is what's important. Basically, we're at all-time highs of household wealth as a percentage of disposable income, and we're all-time lows of the Fed funds rate. So low interest rates affect human behavior. If you get cheap money, cheap credit, people tend to buy more stuff, which is why we see inflation in prices, because there's demand, there's more buying power, and why we see household wealth as a percentage of DPI at all-time highs while the Fed funds rate is low. Now the danger here is when underlying incomes can no longer service the debt, and then we get a turning point. So this is one sort of macro market point that's at highs, that's before the coronavirus. So that was already there. So, all right, now let's take a look at the Miami market and why I felt so confident in saying that it's not a magic unicorn that will defy supply and demand fundamentals. Here is a chart that shows, used as a case study, the city of Miami, 1 million plus condo market. This shows inventory, active listing count. And you'll see in 2013, there was a spike, and active listing count went up 178% since 2013. Meanwhile, 2013, interestingly, was also the top of transaction volume. It was the top of transaction volume in Miami and Miami Beach across price points, by the way. So looking specifically at million plus in Miami, we have inventory went up 178% since 2013. At the same time, volume, demand, we'll call it, dropped 18%. So that is a fundamental disconnect, and that is something that persists here across markets. As in, just as a breakdown, I update inventory quarterly. So 2019 ended with the neighborhood of Edgewater in Miami having 80 months of inventory at $1 million. Downtown having 77, and the South of Fifth region in Miami Beach having 55 months past $3 million. And I'm singling that one out because it's often talked about as a success story. So these are all incredibly bad inventory numbers. I've tracked inventory through the last cycle, and it has never been this bad. Important to keep in mind, this last market cycle in Miami was driven by cash. So Miami Beach was 76% all cash in the 2013 highs, and Miami was 70%. The loss of volume here has been the loss of the cash buyer. Miami Beach has dropped 37% transaction volume since 2013. That's because the cash buyer went away. And because there is so much cash buying, perhaps there is no debt service pressure, and so the market trickle down has been slow. You have all these condo buildings with like 40 listings and 2 sales in the last 6 months for that reason. And that's also why I wrote that this market is vulnerable to an external trigger event that could just escalate kind of the inevitable drawdown. So Fantasyland. Here is my Fantasyland example. I updated Sunny Isles data through January for a piece in the Real Deal by Keith Larson, I think it was a week or two ago. And Sunny Isles passed, just as a case study of Fantasyland here, past $3 million has 156 months, that's 13 years of condo inventory. Past $1 million, there were 729 active listings in the month of January and 9 sales. Past $3 million, 208 active listings and 1 sale. So that, ladies and gentlemen, is not a market. That is Fantasyland. And the same pattern holds at high price points in Edgewater and downtown and Brickell all throughout. It was this fantasy market that was created on optimism and also through very expensive sales centers. People need to keep in mind that pre-construction sales are expensive sales. It's basically, they're the market maker, like for when a stock, it's like a stock promote. They have multi-million-dollar sales centers, pretty girls bringing you coffee, 6 to 10% commission payouts, and they create this illusion, they create this market, and that works perhaps in a time of optimism, but when that time goes away, it doesn't really work anymore. And the market gets distorted when they put these sales in the MLS. So for instance, in Sunny Isles, 5 of the 10 highest sales in the past 6 months were pre-construction sales put in the MLS, but there were the resales took major hits. As an example, in the recently completed Porsche Tower, unit 5403, that unit sold for $3.854 million on January 27th. It sold from the developer in 2016 for $6 million. That's a 36% loss before commissions, before carry costs, before all that. So yeah, that's Fantasyland, and there's a whole lot of Fantasyland in the condo market here, and it's kind of a shame, because the positive story really is that Florida is growing. I was looking at census data. The 2020 census will come out soon, but if we look at 29 estimates, Florida was the big winner for net domestic migration. We had almost 134,000 net population moving into Florida, and Texas was number 2. So people are moving to no tax states. But that's really the story. And also that the Miami area has a shortage of housing for the people who are coming to work and live here. We have the highest percentage of cost-burdened renters in the nation. So I think that, do I think Corona is a black swan? I absolutely do. I think the broader market and the Miami market, we're just waiting for this tipping point. I think that interest rates dropping, the Fed's using its whatever's left of its ammunition. It's just I don't see the good news to save it. I see momentum continuing to build that way. This could be a generational unwinding. I don't know. But the Miami market, I can tell you for sure, is in a very precarious position. And all you really need for the condo market, which is a very simple market, all you really need is 2 charts: supply, demand. Show the volume going like this, show the supply going like this, and it's very, very clear what is going on. It's not a magic unicorn, as I said, but people don't want you to see those charts. They don't want, they want to continue the mirage, which is actually why I started to make these reports publicly available. I was really frustrated by the things I was reading. Like, there was a Fox News segment recently where this lady comes out. She says, "Oh yeah, it's a seller's market in Miami Beach." I said, what? I mean, who even fact checks this stuff? It was absolutely ridiculous. So that's why I started putting this stuff out. Residential real estate is owned by individuals, lots of it, and they rely on their neighbor, their realtor, whomever. They don't have experts advising them, and I think it's a shame that there's so much misinformation and friction, that adds friction to this market and damages real people. So anyways, that's what's going down. I do think that the Miami story has positive components that we need to focus on, like population. Hospitality has been great, and especially in a low yield environment, there's nothing wrong with boring properties that just give you return, like apartment buildings, multifamily, things like this. We have a very growing, stable, underserved population base, and the focus really should be on in-place demand, not on all these projects that are chasing destination money. So I think this all could have a positive turnout in the shakeout. Hope this was informative, and interesting times ahead, everyone.